jump deep into strategies, the trading strategies for trend following system. Now what we're going to do is you are going to be getting 4 strategies, 4 trend following systems, so to call. It's a complete system in itself. Just deploying one of them is good enough, but still we are giving you 4 because whatever resonates with you, you can pick that up. I'm not saying you have to trade in all the 4. I'm not saying you have to trade in and deploy capital in all the 4 and simultaneously run it. No. Learn everything and see what resonates with you and pick that up. Everything works. All of them are good. Your decision is not based on which one makes more money, I'm going to pick that. That's a very, very wrong decision to make. No. Everything makes money based on how the trend happens, how you hold that trade. See which trade you can hold after you understand the system, and see which one you are comfortable and which one you think suits your style of behavior. That is what you got to pick up based on the time frame, based on multiple parameters and so on and so forth. So if you're all ready and excited to get the strategies or the systems for trend following, type in the comment, ready for systems, ready for systems. Awesome. So let's kind of jump directly onto the first system. The first system, we called it as 20 Akasha Bhumi. That's the name what we have given. Trend following system 1. It's called as 20 Akasha Bhumi. Now, for every system, as I kind of share with you, it will have multiple components of it. So we're going to go component by component so that you get everything. All of that put together is a system. We kind of described, discussed briefly previously, what a system is, so you kind of understand that bit of it. So now you are going to get that system here, and you have to kind of understand that. So we will kind of explain this, and we'll also show you on the chart, how it kind of works, and we'll kind of take you through that and see how it kind of comes up. Another thing is, right now, it's important that you learn this, grasp this, come back to this video many times, make lot of notes. It's very important that you make notes the way you have understood that, so that you can kind of go and reproduce that, you can go and implement it in real trades. So make notes, keep coming back, and when we do our masterminds, we will discuss quite a lot of things. So here the importance is that for you to learn and implement, that's what is the most important thing. So now, for 20 Akasha Bhumi, what all is required? So first and foremost, what are the system ingredients? There are many components. I said the first component is the ingredients. Like if you remember, I had spoken about a recipe for cooking. Cooking has a lot of ingredients and methodology to cook. Exactly like that, the system, that's how we'll go. So what are the system ingredients for 20 Akasha Bhumi? First, you need a technical chart. Then you need candlesticks in the chart, and then you need 20 period simple moving average. We've spoken about averages earlier, so you need a 20 period simple moving average, technical chart, and candlesticks. All those 3 you are aware of, so you need these 3. So and then I'm going to talk about one more, and then I go to the charts. Then the second component is the trading time frame. In which time frame will you trade in this system? Each system can be traded in multiple time frame, but what is the best? That is what we're going to share. So here you're going to trade in daily or weekly, whichever suits you. If you want to do daily time frame, you can pick daily time frame. If you want to do weekly time frame, you can pick weekly time frame as well. We have spoken about the time frame as well. So let us kind of discuss that now. I will go to one of the charts. I'll simply open chart and kind of set this up. So you have to understand this. Whichever trading platform you are trading in, every trading platform will have these charts. You have to set it up exactly like that. I'll also show you in one of the trading platforms. So now in this software, which we kind of use, you kind of set this up like this. Everywhere it's going to be exactly same. So this is the normal standard chart, which I've shown you what to kind of have as a standard chart setup. Right. So now here, what do we need? We said we need a technical chart. Yes, this is a technical chart, and it has got volumes as well down below. And I said we need candlesticks. You're already seeing here candlesticks. There are other kinds of charts like the bar chart or the clothesline chart. We don't need those things. We need candlesticks. So So I have taken candlesticks. That was the first component, ingredient. Next is we need a moving average. We need a 20 days. So you click on 20 moving average, and then by default it comes to 20. So I have 20, whichever color you want. Here it's pink color. Maybe I'll change it to blue color. So say okay, and then apply. You get the 20 moving average. So now you have the candlesticks and the 20 moving average line, which is kind of going. Now time frame, I said either daily or weekly. Either one of them you can choose. Both of them work. Either one of them you can choose to kind of trade. So now let us look at it from a daily time frame to start with, and then we will also see weekly how it kind of comes up. So these are the two components, the first two components. We spoke about the ingredients and then the time frame. Both of you, hope you kind of understood. So I want you to go, we'll go step by step, little slowly, but you have to kind of take down, right, these two things. Now these are the first two components. Now if you've got these first two components, and if you're clear about this, just type in the comment, got first two, good, great. Now let's go to the next component. Next most important component is the execution rules. After you get the ingredients, how to cook the food, right? So now execution rules. Here are the execution rules, right? I'll first explain the system, and then I'll give you the execution rules, and then go to the charts as well and explain it very clearly. So pay close attention. Here are the execution rules. To enter, the entry rules is, for a long trade, you have to buy above the crossing candle high. Crossing candle, there is a 20 moving line which is kind of going. Moment the price crosses that 20 moving average, you buy. If the price breaks the 20 moving average, I said the breaks the 20 moving average, the crossing candle should ideally close above this 20 moving average. If it has closed above this, then above that you buy. That is the long entry. Now what is the entry for short? If you have to do the short trade, exactly opposite of that. If the price goes below the 20 moving average, if it is going 20 moving average is here, price is kind of coming down, and the candle goes below, cuts the 20 moving average and goes, ideally it has to close below the 20 moving average. Below that you sell or short. This is the entry for long and short. Let us kind of understand that in the chart here in a minute. So I have randomly taken, this is a Nifty chart. So I'm just going to randomly look at Nifty itself. So let's kind of see here. I'm going to cut this so that you understand this little clearly. I'm going to cut this for a certain period of time so that it becomes easy, convenient to kind of really understand how it kind of really works. Say something like this. Let me cut it till here so that it's easy to kind of follow. So let's say this is how it is. Now what has happened? See here the blue line is kind of going according to the averages, and then the price went up and came down, and once again it is kind of going back up. Here you see this white candle, right? This is a white candle. It is kind of trying to go up, and has gone up, and it actually also has closed above the 20 moving average. Now when it closes above the 20 moving average, moment this happens, a signal has been given by the system to go long. This is the indication, this is the signal. You are not predicting, it is only telling you that if this happens, you have to go long about this. And now this situation has come. The event is such that the candle has broken 20 moving average and it has kind of gone above that. Since it has gone above that, which means right here above this candle, it is ready for you to go long. Moment this happens on any given day. Today is over. Now you see here. Now all you have to do is now understand this. If you want, you can kind of mark a line or something like this here and be ready next day. If the price goes above that, you have to buy. You have to simply buy. Right? That is what it is. So let's see what happens next day. If I move the candle, say one day, oh, next day what happened? Beautiful. See that? Next day market went right above that, much above that, and market opened much above that. So it's a super buy. You simply buy that. Right? That is how the buy happens. Exactly opposite of that is the sell. Let me kind of show you. See here. While this is not the ideal one, but still the price has come below this candle is come below this. Minute it comes below this, now you have to be ready. If it goes further below, you got to sell, short the market. So here, somewhere here, ideally would have been, waiting to short below here, below this candle, but it is like too much, so you could even sell here. This is being slightly aggressive. If the market even touches that, that is aggressive. If you want to be slightly conservative, wait for it to close and then you short here. So you would have short here, and then again here we have kind of done the long trade. Once again market went below, we short it here. Now once again we are going long. So that is how the long and short happen. So this is only the entry. I only explained the entry part of it, right? Hope you are kind of getting the entry part of it. Now let's go and understand this, like few more aspects of it. Next aspect is, when do you exit? Very simple, very simple. For long, you will exit long below the breaking candle. Long means for long trade. If you have taken a long trade and market is going up and suddenly the price starts to come down, once again when the price cuts the 20 moving average from top and comes below, that is a place you exit. And remember and note, observe, when the long trade ends, where you exit, that is also the point where the short trade starts. So trend following is a perpetual system. You constantly do long and short and long and short. So you're always in the business of trading. The business never stops for us. So trend traders. So it's constant. So exit long below the breaking candle low if the price goes below the 20 SMA line. That is what you will do. And opposite of that, exit short above the crossing candle high if the price goes above. You would have taken a short, you would have going down when the market reverses, comes above the 20 moving average. You once again buy that. That is exit. That is the entry and exit rules. Now there is a re-entry. What is the re-entry? Re-entry is if the price touches 20 SMA and the trade exits as per the RMs. What are RMs? RMs stands for risk management. I'm going to talk about that in a bit. So RMs stands for risk management rules. RMs or exit rules. Take a re-entry if the price once again travels in your original trade direction. I'll explain what that is as well. So you got entry, exit and re-entry. Re-entry, let me kind of explain it in the chart once again. So now right here we took this trade, it went long. Let's see what this trade does. And after we have entered long, see, it's simply going up. I'm just moving it candle by candle, and it is constantly kind of going up day after day, day after day, day after day. As I keep moving it, see, beautiful. Now see what happened here. Here it came down, it touched here, it touched the 20 moving average, but this line did not close below. But to be on the safer side, maybe if you are not an aggressive trader, what you will do is you will exit the trade here. You entered here and you would have exited here, you would have exited. But after that, what happened? Look at this, market is once again going back up. If this kind of situation happens, you can re-enter the trade above this candle. Above this candle, you re-enter and continue with the trade because it's in the original direction. This exit should not have happened. It's a blip. Sometimes those blips happen, right? And when it happens, you have a re-entry and you once again travel in that direction and keep going. See here, after that it has gone further quite a lot, and then here the trade got exited, and here the short trade started from here. That is how. So we entered long here above the 20 moving average. Once it closes here, there was a re-entry. It was a blip, and we took re-entry, and then here what happened, it closed below the 20 moving average beautifully, and then here we short the market and continue with it. As simple as that. Extremely simple, but extremely powerful. I'll show you a few charts for this. So that was on the entry, exit and re-entry. So far if you have got the execution rule, type in the comment, got execution rules. You may have doubts. Beautiful, no problem. Keep all your doubts handy and when you're in the community, you can kind of raise that query in the community and we will help you understand. And of course, when we do our masterminds, we will have that deeper explanation and conversation as well. But for now, important to understand this. So that was the execution rules. Now, next one, next continuation of this. What is the risk management rules here? I told you the system should have all the aspects, ingredients, time frame, execution rule, risk management, all of that put together is the system. I've explained that. So we are giving you all of that. So now what is the risk management rules here? Very simple. Risk management. Initial stop loss. I've explained what is stop loss. So initial stop loss will be entry minus 4% for stocks if you do it on stocks. 2% if you do an index, which is Nifty, Bank Nifty. 2.5% if you do it on commodities. So different stop losses for different kind of scripts, because each one behaves differently. So because of that, based on understanding that, we are giving you different stop loss percentages. So initial stop loss for a stock, say for example you do it on Reliance, Tata Motors, whatever you do, that is what it is. 4% is what you will give, which means if you have entered at say 100 rupees, 100 minus 4%, that is where you will keep. In case after entry, if the market reverses, you cannot kind of hold on to that, right? It will kind of be pretty sad there. You will kind of exit. You will kind of keep losing money. You will not know where. So instead of losing too much, you kind of do. So 1 or 2 trades may be blips like that. It's fine, right? That is the first risk management rule here. Second is, once the trade is in the money by 4%, I've explained what is in the money, which means if you take the trade and if it starts to go in your favor, moment it goes to 4% in the money, you make 4% profits. Then what happens? Your stop loss is below, you move your stop loss up and put it here. I'm going to show you that in the charts as well. For 4% for stocks, 2% for, 4% for stocks, 2% for indices, and 2.5% for commodities. You can use 2.5% for commodities for bringing it to break even. Once it comes to break even, that trade, even if the market reverses, you will not lose money. It's a no profit, no lose, no loss trade, right? And then the last one is beyond 4%. If the market starts to go beyond 4%, and when 20 moving average it goes above your BEP point, then start trailing at BEP until the trade ends at BEP. So these are the three risk management rules. Here what we are doing 2 things. One is we are cutting our loss short. Second, we are protecting our capital, which means moment if we are right, once we are right, we don't want to give money back to the market. We're going to protect that. We may not take it, but we will protect our capital. Third, once market says you are absolutely right, we will safeguard the profits as well, so that we get the big profit which we can take home. At least if you get small profit, that is also good, right? So now let us kind of see this once again, how it kind of goes. I'll kind of remove all of these lines once again, right? So now, for example, here we went long. If we go long, say whatever is the value, say this value here this is on Nifty. In Nifty, this value looks like it is 11,929 or whatever. So 11,929 minus 4% you will calculate and put a stop loss. So that stop loss may be somewhere at this point. At this point could be your stop loss as an example. So in case if this particular trade, instead of it going up, what if the market from here had come down like this, so that you can exit at that point in time automatically. Now this trade is beautifully kind of gone in your favor and it has gone up. Now from here you will calculate 4%, and that 4%, so you enter wherever you would have entered, you calculate 4% from the entry and say this is the 4%. Moment the price comes here, this was your original stop loss here in the blue line. You will cancel this here, and you will put your stop loss at entry, which means you are coming to break even. In case after having gone this much, and if the market kind of comes down like this, you will not lose any money, which means you are break even. And the last one, once the market goes above this 20, this blue line, see this blue line goes above this blue arrow here. Here we have the blue arrow. Let me change this to some other color so that it's easy. So this green arrow. If the minute the market price goes above this green arrow, this blue line goes above this, then as it goes above, you will trail at this 20 moving average. This is you becomes your trailing stop loss. Stop loss, but it is trailing. Every day as the market goes up, your stop loss also you are kind of going on increasing, which means what? You are protecting your profit. See, on any given day like this, if market comes down, you will exit here. So because this is your stop loss. And see here, this you would have exited. Because of that, you would have exited here because you are trailing, but you can re-enter once again here and then completely ride and finally exit here. That is the beauty of this system. So you kind of hope you kind of are getting the crux of how it kind of works, the execution rules and RM rules. So go through this video once again, neatly, clearly understand, and go through all of these rules once again, step by step. We have listed down very step by step so that it's very easy to understand. No complication, and it is very simple and straightforward. Go through this multiple times and you will definitely kind of get this. It's a very easy thing to kind of know. So far, if you've kind of understood this, type in the comment, got the system one. Now I want to show you a few scripts how it kind of really works on this system. Right, this is extremely beautiful. So I'm gonna remove all of this. I'm gonna randomly show you a few things how it works. It's marvelous. Look at this Tata Motors. So on daily time frame, see here short. This is where the short trade started. Let me kind of cancel this. This is where the short trade happened. The short trade exited here. Long started. Here there was a blip short, again came back, again long here, went completely from here to here, got this completely, and here got this much short, then again here from here to here long we got, again from here all the way till here we got long, right? And then here there were a few blips, and then again this long we got completely, and then we got this short completely, and then again long has just kind of started from here. So it's so beautiful. I just showed you on one of these charts. You can kind of look at as many charts. It works beautifully both on daily. Now I'll show you the same Tata Motors on weekly, even more powerful. Look at this. Trade started here all the way, one big trade. Then this long trade did not work. Again short trade worked. Again this long trade worked. Complete short trade worked, one long big trade in weekly time frame, and finally short trade. So extremely powerful. The system is, don't even think the system is either complex or difficult to understand. No, it is extremely simple. Just go step by step. The concept is, if the price is above 20 moving average, you will do long trade. If the price is below 20 moving average, you will do short trade. That is the concept. That is the Dow theory concept. So now see how the Dow theory is working, right? So the bottomist may be somewhere here. From here it started to go up, but I did not go long right from here. I entered long only here. So this much I left out, right? Topmost was here in this trend, but I did not exit here. I exited here. So how much I got? So I left out this much here. I left out this much. I left out this much here. I got only the between 60%. Dow theory, perfectly syncing to the Dow theory. All the trend following system, what you will learn, will sync to Dow theory. That's how it is going to be there. And that is how this kind of works. Extremely beautiful, extremely powerful. Works both on daily and weekly. So you choose which time frame you want to do, and simply go through that, and it's going to be marvelous. So hope you kind of got this, and you are kind of already excited to try this out and see how it kind of works. So if you've got the first system, type in the comment, got 20 Akasha Bhumi, got 20 Akasha Bhumi. Awesome. Enjoy that, and I'll see you in the next video, and we'll talk about the next system. See you in the next video. Bye.